If you observe carefully the price of gold over the past 4 years, you'll notice something that most people are interpreting completely backwards. They see gold rising from $1,800 to over $2,600 per ounce and celebrate it as a bull market. They talk about gold's strength, gold's momentum, gold's breakout. But they're looking at the wrong side of the equation. Gold isn't getting more valuable. The dollar is losing its purchasing power at an accelerating rate. And what you're witnessing is not gold going up, it's the dollar going down. This isn't just semantics. Understanding this difference will determine whether you protect your life savings or watch decades of hard work evaporate in what I call the great wealth transfer. By the end of this analysis, you'll understand exactly what's happening, why it's accelerating, and what you need to do about it before it's too late. This isn't a prediction. It's a logical consequence of observable mechanisms that are already in motion. I've spent over 40 years studying debt cycles, currency debasements, and wealth transfers across empires and economies. When you understand incentives, you understand behavior. And right now, the incentives driving the Federal Reserve, the Treasury Department, and the U.S. government point in only one direction: more currency creation, more debt accumulation, and more debasement of the dollar. Consider these 3 data points. The U.S. national debt has surged past $36 trillion, up from $23 trillion just 4 years ago. That's $13 trillion in new debt in 48 months. The Federal Reserve's balance sheet, despite supposed quantitative tightening, remains at $7.4 trillion, nearly double its pre-2020 level. And perhaps most telling, central banks globally purchased over 1,000 metric tons of gold in 2023 alone, the highest level in over 50 years. These aren't random statistics. They're signals of a system that knows what's coming, even if the general public doesn't. To understand what's really happening, you need to grasp a fundamental mechanism that most people never consider. Imagine a seesaw. On one side sits the dollar's purchasing power, what a dollar can actually buy in real goods, real assets, real value. On the other side sits the supply of dollars in existence. For decades, this seesaw stayed relatively balanced. Yes, it tilted slowly over time as more currency entered circulation, but the movements were gradual and manageable. Most people didn't notice their purchasing power eroding because it happened slowly enough to be absorbed by rising nominal wages and productivity gains. But something changed dramatically in recent years. The dollar supply side of the seesaw got loaded with enormous weight in an incredibly short period. From 2020 to 2024, the U.S. government created more currency than existed in the entire monetary system before 2008. Think about that. More dollars were created in 4 years than in the previous 230 years of American history combined. When you flood one side of a seesaw with weight, the other side has to rise. Or in this case, the purchasing power side has to fall. This is exactly what you're seeing when gold goes up. You're watching the purchasing power of the dollar collapse in real time. And gold, which cannot be printed or created at will, is simply maintaining its relative position. The current pressures accelerating this collapse are unmistakable. First, the interest expense on the national debt now exceeds $1.1 trillion annually, more than the entire defense budget. This cost is mathematically unpayable without either explicit default or monetary inflation. Second, unfunded liabilities for Social Security and Medicare exceed $200 trillion in present value terms, with the first major demographic wave of retirements now underway. Third, de-dollarization is accelerating as countries like China, Russia, India, and Saudi Arabia increasingly settle trade in non-dollar currencies and accumulate gold reserves instead of treasury bonds. History is an excellent teacher, and what we're witnessing isn't new. It's a pattern that has repeated throughout monetary history with devastating consistency. In August 1971, President Nixon closed the gold window, severing the dollar's last link to gold. At that moment, gold was fixed at $35 per ounce. By 1980, gold hit $850, a 24-fold increase. But gold didn't become more valuable. The dollar lost 96% of its purchasing power against real assets. A gallon of gasoline went from 36 cents to $1.25. A median home jumped from $25,000 to $64,600. The pattern is unmistakable. When government removes discipline from currency creation, the currency collapses against hard assets. The 1970s saw what we're experiencing now. Inflation came in waves, peaking above 14% annually by 1980. Americans who held cash and bonds were devastated. A retiree with $100,000 in 1970 found it could purchase only $40,000 worth of goods by 1980. But those who held gold and productive assets saw their wealth preserved and multiplied. Consider Weimar Germany in the early 1920s. After World War I, Germany faced enormous reparations it couldn't pay through taxation. The solution was printing currency. In 1919, $1 bought 4 marks. By November 1923, $1 bought 4.2 trillion marks. German citizens who saved in marks were wiped out. Those who held hard assets, gold, farmland, equipment, preserved their wealth entirely. The currency unit simply disintegrated while real assets maintained value. The 2008 financial crisis provides another example. When Lehman Brothers collapsed, gold traded around $800. The Federal Reserve's response was unprecedented. Quantitative easing expanded their balance sheet from under $900 billion to over $4.5 trillion by 2015. Gold surged to $1,900 by 2011. The pattern holds. Massive currency creation leads to debasement, manifesting as rising hard asset prices. The difference now is scale and speed. What seemed shocking in 2008 looks modest compared to today. To understand what's happening with gold and the dollar, you need to understand 3 fundamental principles. These aren't complex economic theories. They're basic mechanisms that govern currency value in every economy throughout history. The first principle is this: currency is a claim on production, not wealth itself. When you hold a dollar, you don't hold wealth. You hold a piece of paper or a digital entry that represents a claim on future goods and services. The value of that claim depends entirely on 2 factors: how many other claims exist and how much production those claims can purchase. When government doubles the number of claims without doubling production, each claim becomes worth less. It's pure mathematics. Think of it like shares in a company. If a company has 1 million shares outstanding and issues another million shares without increasing the underlying business value, each share is now worth half as much. The exact same principle applies to currency. From 2020 to 2024, the U.S. increased the monetary base by over 40%, while real GDP growth remained around 2% annually. The mathematical consequence is inevitable. Each dollar represents a claim on less real production. The second principle is that governments always choose currency debasement over explicit default. This pattern has held true for thousands of years, from Roman emperors clipping coins to modern central banks creating digital currency with keystroke entries. Why? Because explicit default is politically catastrophic. It means telling bondholders, pensioners, and government employees that you cannot pay what you promised. Currency debasement, by contrast, is subtle. It allows governments to technically pay their obligations while reducing the real value of those payments. Consider a government that owes $1 trillion in bonds. It can either explicitly default and say we cannot pay, which causes immediate political crisis, or it can print the money to pay, which causes the dollars received to buy less, but allows politicians to claim they met their obligations. Every government throughout history has chosen the second option. The current U.S. situation makes this choice even more certain. With $36 trillion in debt and unfunded liabilities exceeding $200 trillion, explicit repayment is mathematically impossible. The only question is whether default comes explicitly or through inflation. History tells us which path will be chosen. The third principle is that gold is the ultimate alternative to unbacked currency because it has unique monetary properties that nothing else possesses. Gold cannot be created at will. Annual mine production adds less than 2% to above-ground supply. Gold is universally recognized across all cultures and time periods. A gold coin from ancient Rome is still valuable today. Gold has no counterparty risk. It's an asset, not someone else's liability. And gold has no expiration date or degradation. It's as valuable in 3,000 years as it was 3,000 years ago. When currency debasement accelerates, people instinctively seek these properties. They want something that cannot be printed, that will be recognized and valued in the future, and that doesn't depend on government promises. This is why every major currency debasement in history has been accompanied by surging gold prices. It's not that gold becomes more valuable, it's that people flee collapsing currency into the only asset that has served as money for 5,000 years. We're seeing this principle play out right now. Central bank gold purchases reached record levels not because central bankers are speculators hoping to profit, but because they understand these principles and are preparing their nations for dollar debasement. Let me tell you a story about two families that illustrates exactly what we're discussing. In 2007, before the financial crisis, two families had each accumulated $800,000 in retirement assets after 30 years of work. The Johnsons kept everything in safe assets: 60% treasury bonds, 30% cash, 10% dividend stocks. Their advisor emphasized capital preservation. The Richardsons took a different approach: 20% cash for emergencies, 40% in real asset stocks, energy, mining, agriculture, and 40% in gold and silver, split between physical metals and mining companies. Their advisor called this reckless. Fast forward to 2024. The Johnsons' bonds paid interest, but after inflation and taxes, real purchasing power declined. Their $480,000 in bonds returned roughly 3% annually, but inflation averaged 4%, and they paid taxes at 22%, leaving them with real losses. Their cash lost purchasing power every year. After 17 years and cumulative inflation of 85%, their $800,000 could purchase what roughly $432,000 could buy in 2007. They preserved capital in nominal terms but lost over 40% in real purchasing power. The Richardsons experienced something completely different. Their gold allocation grew from $200,000 to approximately $650,000, as gold moved from $800 to $2,600. Their silver and real asset stocks delivered strong returns. Their total portfolio reached roughly $2.1 million by 2024, wealth that maintained its purchasing power against real goods. This isn't made up, it's the typical pattern. One family followed conventional wisdom about safety. They didn't understand that holding currency during debasement is the riskiest position possible. The other family understood that real wealth means claims on real assets, not currency that can be created without limit. The Johnsons thought they were being conservative, while the Richardsons thought they were taking risks. In reality, it was exactly the opposite. Now let's translate this to what really matters: how this affects you. If you're between 50 and 70 with retirement savings between $300,000 and $2 million, you're in the crosshairs of what's unfolding. You've spent decades building this nest egg, and the majority of you have wealth in exactly the wrong place. Currency-denominated assets being systematically devalued. Let me make this concrete. If you're 62 with $750,000 allocated like most Americans, 50% bonds, 30% stocks, 20% cash, here's the next 5 years. If the dollar continues losing purchasing power at even half the current rate, your $750,000 will buy what perhaps $450,000 buys today by age 67. Your account balance might stay flat or rise nominally, but everything you need, groceries, medicine, healthcare, maintenance, utilities, will cost 40 to 60% more. Think about daily life. You plan to withdraw $40,000 annually to supplement Social Security. 4 years ago, $40,000 covered property taxes, insurance, food, healthcare, utilities, and modest travel. But if inflation continues at 6% annually, that lifestyle will cost $53,500 in 5 years. Your planned 4% withdrawal just became 7% in real terms. Instead of savings lasting 25 years, they'll be depleted in 14. You'll be 76 with savings exhausted and no ability to return to work. This isn't fear-mongering. It's mathematics applied to current trends. The dollar has lost 22% of purchasing power since 2020. Applied across a retirement budget, this means crisis. The couple who thought they had sufficient savings discovers they don't. The person planning to leave an inheritance discovers there's nothing left. Based on these principles, here are practical guidelines that can protect what you've built. I'm going to be specific because vague advice helps no one. These allocations aren't perfect for everyone. Your situation, risk tolerance, and time horizon matter, but they represent a rational response to observable currency debasement. For someone with $500,000 to $2 million in retirement assets who understands what's happening, consider this framework. Allocate 40% to physical precious metals and precious metals mining companies. This means 25% in physical gold and silver, actual coins or bars you can store securely, or through allocated storage programs where you own specific audited metal. The remaining 15% goes to established, profitable gold and silver mining companies with strong balance sheets and proven reserves. Allocate 25% to real asset businesses, energy infrastructure, agricultural companies, water utilities, industrial materials. These are businesses that own or produce real things the economy needs regardless of currency regime. Allocate 15% to productive real estate, rental properties that generate income, farmland, or REITs focused on essential property types like self-storage and multifamily housing. Allocate 10% to high-quality international exposure, companies or assets based in countries with stronger fiscal discipline or resource advantages. Allocate 10% to Treasury inflation-protected securities or short-duration bonds. This provides some stability and liquidity while offering minimal inflation protection. Keep the final 10% in cash and money market funds for emergencies and opportunities. This allocation might seem radical compared to conventional 60-40 stock-bond portfolios, but consider what you're protecting against. You're not optimizing for maximum returns in a stable currency environment. You're protecting against currency debasement that is observable, measurable, and accelerating. What you absolutely must avoid is equally important. Don't hold long-duration bonds with rates below inflation. You're guaranteeing real losses. Don't keep large cash positions beyond emergency reserves. Every month, that cash loses purchasing power. Don't assume your home equity alone protects you. Residential real estate is leveraged to currency and doesn't generate income. Don't think traditional diversification into stocks and bonds provides safety when both are denominated in the same depreciating currency. And critically, don't wait for permission from conventional advisors who may not understand these dynamics or whose business model depends on assets under management in traditional portfolios. Implementation matters as much as allocation. Don't rush to make these changes overnight. Create a plan to reposition over 6 to 12 months. Dollar cost average into precious metals. Buy systematically regardless of short-term price movements. Because you're not speculating on gold's price, you're protecting against dollar debasement. Work with advisors who understand hard assets and monetary history, not just those who follow conventional models. Prepare yourself psychologically for volatility. Gold and real assets will fluctuate, sometimes dramatically, but their long-term trajectory against depreciating currency is clear. And understand that this positioning isn't about getting rich, it's about not getting poor. The goal is preserving purchasing power across a monetary transition, not speculating for gains. Common pitfalls to avoid include trying to time the market. You cannot predict short-term movements, so build positions systematically. Don't use leverage or derivatives. In currency crises, leverage destroys wealth even when directionally correct. Don't confuse paper gold, like unallocated ETFs, with physical ownership. In a real crisis, the distinction becomes critical. And don't underestimate storage and security for physical metals. This is real wealth that requires real protection. Nothing in this constitutes specific financial advice. Each person has different circumstances, goals, and constraints. You should consult qualified professionals who understand both your situation and these broader monetary dynamics before making significant portfolio changes. What I've provided is an analytical framework based on observable patterns, not personalized recommendations. The choice is yours. But remember what's actually happening. Gold isn't experiencing a bull market driven by speculation. The dollar is experiencing structural debasement driven by mathematics that no political party can reverse. We are too far into the debt cycle for any other outcome. The institutions managing real wealth are making their moves. Central banks purchased over 1,000 metric tons of gold last year, the most in 5 decades. They're not doing this for tradition. They run the monetary system and see what's coming. The Bank of China, Central Bank of Russia, Reserve Bank of India, they're converting dollar reserves into gold because they understand incentives and mathematics. When a system has $36 trillion in debt and $200 trillion in unfunded liabilities, the outcome is predetermined. Only timing varies. That's why this channel exists. We observe signals before they become obvious. We connect mechanisms conventional analysis ignores. We speak uncomfortable truths financial institutions cannot say to clients. If this analysis makes sense, if you see the logic, if you understand we're not watching gold rise but the dollar fall, you need to see the world differently from now on. Every time someone celebrates gold hitting a new high, translate it correctly. The dollar just hit a new low. Every time economists assure you inflation is under control, understand the incentives driving that message. Every time conventional wisdom tells you to hold cash and bonds for safety, recognize you're being positioned as the counterparty to the greatest wealth transfer in modern history. The mathematics are clear. The historical precedents are clear. The institutional movements are clear. What remains unclear is how many individuals will recognize what's happening in time to protect themselves. Will you preserve what you've built across decades, or watch your purchasing power evaporate while your account balance provides false comfort? The choice is yours, but this choice has a timeline, and it's compressing. What took years in previous debt cycles now unfolds in months. The signals are no longer subtle. Gold isn't going up, the dollar is collapsing, and those who see this clearly will protect their families, their futures, and their financial security through the transition ahead.